ROBS is a system that's in place that the Treasury allows to happen for people to take their monies from their IRA, any of their retirement accounts, except for a 401k where you're still employed. And what you do is it's called a rollover. And what it is they're setting up a sub-C corporation for you. That sub-C corporation now owns and operates that business entity that you're running the business from. Be it an LLC, a sub-S, whatever that business is, the sub-C still owns it, and you're a managing member of that sub-C. The reason folks do it is you do not have to pay your penalty for early withdrawal, and you do not have to pay income tax on the money that you pay. Because under the government's eyes, I love using those two fingers when I say that, it is legal to move it into the sub-C, even though the money is not any longer in the sub-C. It is used to purchase the franchise and to operate the business. That's the premise of it. There are many, many restrictions and compliance obligations when doing a rollover. And you also have to remember it is a sub-C corporation. The government tends to look at sub-C corporations a little bit more because of the fact that they know they're doing them as rollover businesses. Your retirement account actually owns the business. It is not yours. You're a managing member or an operating member, and you can only take what's construed as a fair market salary from the business. So here's the best way to look at it. Your business, you started, it does great. At the end of year one, you have $500,000 of profit. That is not your money. That money belongs to the sub-C corporation that owns your business. You cannot take profit sharing from it. You can only, once again, take fair market value salary. The catch-22 to that is, what is fair market value salary and who sets that? It would be an industry standard for people. And I think that's the real gray area of the ROBS, is making sure if you're going to do it, that whoever you use keeps you in compliance, because it's very important. Otherwise, they can come back and you could be taxed and penalized on that monies that you've taken out. And I don't know if the benefits outweigh the risk that's involved in it, but I know it is used quite frequently for people who really don't want to take on a loan or have debt service. It is actually owned by the sub-C. That money goes back into your retirement account. You cannot touch that. You can eventually touch it if you hit 62 and a half, I think it is, or somewhere in there. You don't have to pay the penalty, but it still becomes income tax. So if you sell business for $2 million, you put it back it goes right back into your sub-C. It's not yours, obviously. Even though you're the managing member of the sub-C still owns it. That money goes back into the sub-C. So let's say it's $2 million. You then can take money from that account from your retirement. But once again, if you're not 62 and a half, you have to pay the penalties, which is normally, I think, 10 to 12% penalty for early withdrawal. And any monies that you take goes into as income tax. If it's $1 million you're taking, you're paying 30% to take that money. So in the long run, what happens is you really didn't sell that business for that amount of money, because you're going to be taxed on all of that that's there. So it's something that you really have to take into consideration.